Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to join in and ask questions. If you are a first-time listener and would like a little bit more information about our private client services and our philosophy of transparency, we have a separate introductory webinar that will provide you with this on our website adjacent to this weekly webinar. Well, as a point of interest and to keep ourselves humble, each week we look at the top Google searches to see what Canadians are most interested in. Now, last week's top Google searches included Michael J. Fox, Hurricane Patricia, the Blue Jays, and the Montreal Canadiens. That's Sports 2, Entertainment 1, and Weather 1. Financial news was shut out once again. So, even though it may not be at the top of done, the Chinese central bank cut lending and deposit rates and reduced reserve requirements, all adding even more financial stimulus to the struggling Chinese economy. As I mentioned earlier, equity markets like this and the S&P 500 actually had a two-day rally on Thursday and Friday of about 2.5%. Now, this took us through the recent downtrend line going back to the summer, actually late May, some selling resistance came in at about the 2080 level on the S&P 500. Now, any sell-offs back to the 2030, 2040 levels should be met with some buying support, but we really think that short-term trading ranges will be more clear after the U.S. Fed meeting announcement tomorrow. I'll talk about that in a little bit more detail in a moment. Meanwhile, the euro fell and the US dollar rose as the anticipation of lower euro interest rates and lower economic growth decreased the demand for euros. Well, the stronger US dollar, however, makes US goods more expensive overseas, and this has been having somewhat of a negative impact on the US economy. Already we have seen the slowing of the US manufacturing sector. Today's data on orders for durable goods only added to the concerns. And on Thursday of this week, we're going to see the first reading on US third quarter GDP, which is expected to come in at a much slower 1.7% annualized rate of growth versus the second quarter pace of 3.9%. So that will be looked at with significant interest on Thursday. But prior to that, today and tomorrow, the U.S. Federal Open Market Committee meets to decide whether or not to make any changes to monetary policy. While they want to begin the normalization of interest rates as soon as they possibly can, it appears that, as we have been suggesting for some time here at High Rock, that the U.S. economy is being slowed by the global economic situation and the stronger U.S. dollar. So the U.S. Federal Reserve, although they had been rather optimistic in their views for the U.S. economy earlier in the year and had wanted to begin raising interest rates in 2015, well, this is what had been hoped for, stronger U.S. economic growth in the second half of 2015. But we counseled that we should, in fact, expect the unexpected, and basically that global forces would be too much for the largest economy in the world to be able to shrug off. And another expectation that we warned was vulnerable when many called for a September increase in rates. Well, it now looks like it may be postponed to sometime in 2016. It appears unlikely that the Fed will go in the opposite direction of the rest of the world's central banks that are either easing monetary policy or at least holding steady. We'll find out more tomorrow at the 2 p.m. announcement. Well, as we have mentioned on many occasions, most central bank mandates are focused on price stability. Here at home in Canada, Canadian inflation increased as the Canadian dollar weakened earlier in the year, but more recently, lower commodity prices have started to push inflation back down. In last week's decision, the Bank of Canada, while still holding on to its optimistic spirit, saying that the dynamics pointing to a pickup in 2016 and 2017 remain largely intact, they left interest rates unchanged. And although not only did it downgrade its forecast for Canadian growth, it further raised the risks to its forecast. While household spending continues to underpin economic activity, financial vulnerabilities in the household sector continue to edge higher, which basically says that what is now helping the Canadian economy may in fact turn out to be, we'll watch how developments evolve. Well, around the global economy, back and on the inflation front, in the euro area, core inflation remains well below the 2% target and is one of the catalysts for the European Central Bank's desire for continued aggressive monetary stimulus. The Bank of England has kept rates on hold as core inflation has remained below target, and concerns over the direction of the global economy are front and center. In fact, today's third quarter GDP announcement from the UK showed further slowing in economic growth. In Japan, Japanese inflation has slipped below the zero level, so back into deflationary territory. Now, while the Bank of Japan left monetary policy unchanged, they also see elevated risks to the downside for the Japanese economy. With all other central bankers concerned about lower inflation and slowing economic growth, the impact of a Fed interest rate increase could create considerable financial market volatility. Central banks don't like volatility as a rule because it erodes confidence and forces economic decision-making to be both postponed and, in fact, then hurts the economy. So we think that global economic concerns have tied the hands of the U.S. Federal Reserve. While the volatility continues to be below its current average and has calmed down considerably since its spike in August, if the Fed were to raise rates tomorrow, volatility would spike higher. We suggest that this is not something the Fed wants to see. So what do we see coming? Well, from looking at the bond markets, as I reported earlier, 10-year U.S. bond yields are little changed on the week as bond markets have traded in a narrowing range, mostly awaiting tomorrow's Fed meeting update. But for the moment, bonds are not pricing any change in interest rates until well into 2016. When we look at all the various yield curves around the globe, with the ECB announcement, the German yield curve actually shifted lower, and negative yields have now moved out to 6 years from 5 years where they were when we chatted last week. U.S. short-term yields are at 0 out to 3 months, and there's an indication there that this particular, the fixed income market here doesn't expect to see any Fed interest rate increase anytime soon. High yield bonds lead equity markets. We've talked about this regularly on this call. High yield turned lower early in 2015, and the S&P 500 followed starting in May, but largely played a lot of catch up in August. The last week's move higher in the S&P 500 widened that gap again. History is going to tell us that the U.S. equity markets are ahead of themselves. We think that they're going to have to probably correct lower. And so nobody thinks that there's a surprise here. We still think equity markets not only are expensive, but they got more expensive with the most recent rallies. And as I said earlier, all indications are that we may not see a Fed rate increase this year. Now, investors and traders who borrow to buy equity assets are relieved, and that has been the catalyst for the jump in equity prices. However, over time, the fundamentals will come back to roost. So we're staying with heavier weightings in cash in our models, in our equity models, and to take advantage of cheaper prices down the road when we get them. Looking at how expensive equity markets have become, the 10-year average price to earnings ratio on the S&P 500 is 14.1. Currently, the forward 12-month average is at 16.2. Last week, we reported it at 16. Last May, it peaked at 17. Of the 173 companies that have reported earnings to date for the third quarter of 2015, 77% have reported earnings above the mean estimate, and 43% have reported sales above the mean estimate. For the third quarter of 2015, the blended earnings decline so far is minus 3.8%. Now, on September 30th, the estimated earnings decline was for 5.1%. So, in fact, we've seen somewhat slightly better than anticipated earnings so far. But again, we're only a quarter of the way through the earnings announcements for the S&P 500. 8 sectors have higher growth rates relative to what was expected due to upside earnings surprises, and this has been led by the telecom services sector. In the other metric that we like to look at, enterprise value to earnings, S&P 500 companies are valued at right now at current market prices at 12.5 times. That's up from 12.25 times last week. The 10-year average is just a little under 11 times. But as Paul has mentioned on previous calls, in our tactical growth model, we are not much interested in anything that is over 8.5 times. So we look for value when we make purchases at High Rock. We don't see value at any point in the equity markets at this particular point in time now. Well, each week we also monitor margin debt, which traditionally has been another leading indicator of equity price movement. Investors who borrow or use leverage to buy equities are okay as long as returns are greater than the cost of borrowing. When asset prices drop, lenders either want more margin or they want the borrowers to pay down their debt, which means that the borrowers need to raise cash. Well, they do this by selling assets. In some cases, they are the most profitable assets. In some cases, most liquid assets. But this selling increases volatility and uncertainty. Historically, a decline in margin debt, as we saw in 2007 to 2008, will lead equity prices lower. After record levels of margin debt earlier this year, we think we could be seeing a similar margin-related equity selling coming into the equity markets now and in the near future. So that really begs the question as to, if equity markets are higher, who is buying equities? Well, if we look at this chart, and I know there's a lot of numbers on there, but if you look under client, according to Bank of America Merrill Lynch Global Research, only really one particular entity has been buying equities, and that's corporations. And corporations have been buying their own stock. So we call those buybacks. But if we look and see, there's been really no other significant buying, some retail buying of ETFs, but really not any other significant buying. What does that mean? It means that, in all likelihood, this uptick is not going to last. And so that's the way we will structure our portfolio models as we go forward. Once again, being very, very protective of our and our clients' capital along the way. Well, as we've often said, we believe that we are in a low return environment, but it's especially worrisome when there's so much outstanding debt, and that returns will not justify the cost of that debt. Again, we advise caution and will be being very cautious as we move forward. In other news this week, we have seen that there has been a new study released in regards to the impact of mutual fund trailer fees on the performance of mutual funds. And at HIROC, one of our key philosophies is that fee transparency is essential. We believe that clients need to be clear on what the costs of investing are. This is part of the trust that we build with our clients. What we have seen amongst the investment advice community, in our experience, is that that's not necessarily the case. Now, this study commissioned by the Canadian Securities Administrators for Douglas Cummings and released last week shows that conflicts of interest exist for advisors who sell mutual funds and receive trailing commissions. Now, in the UK and Australia, trailer fees, as they are known, have been banned for this reason. At HIROC, we hold ourselves to a higher standard than is required by the investment advisors under the Investment Industry Regulator of Canada, which is otherwise known as IIROC. Licensing, their licensing requirement does not require a fiduciary responsibility. But at HIROC, under our license with the Ontario Securities Commission, we are required to put our clients' interests first. We cannot have any conflicts of interest. Mutual fund trailer fees do represent conflicts of interest. So at HIROC, we will never own mutual funds for our clients in that capacity. Well, as always, our focus is on getting good risk-adjusted returns and not being driven to chase higher returns at the expense of adding risk to our clients' portfolios. This is something that we continue to maintain in our decisions on the best directions for our portfolio models at this particular point in time. At HIROC, we use 3 investment models with which to build our balanced portfolios. Clients can use any combination of these models to build their portfolio depending on their goals and risk tolerance as determined by their wealth forecast. In my 60% equity, 40% fixed income portfolio, this year the return has been approximately positive by 3.5% so far this year. Okay, Paul, Do you have anything you wish to add to today's conversation before we go to the question and answer period?
No, I'm good. Thanks, Scott.
Okay. So if that's it for our regular discussion, if anyone might have a question, this is the time now to feel free to jump in.
Can you explain a little bit more about the, you were talking about how corporations were the ones that were purchasing equities, right? And how does it differ from years gone by? Because I was just quickly looking at the chart, and it looked like it was always corporations doing a buyback. Is that true?
Scott, perhaps you can pull that. Yeah, maybe you should pull that table back up from B of A, and our listeners can probably see it while we explain it.
There you go.
The table, the data doesn't go back all that far, but as you can see in 2008, stock buybacks by corporations were effectively zero.
Right.
And on the come up from the credit crisis in 2009, they obviously did some, but then they really ramped it up the last 5-6 years. It's been moving steadily higher.
Right. So I guess my question is, does this year differ that much? Is it that much different from just like a few years gone by, like 12 through 14? And
no, not necessarily.
And what does that mean?
Well, I think the takeaway here is that institutions have been pretty big sellers. So those would be large treasury departments, mutual funds, et cetera, have been pretty big sellers. The stock buybacks by the corporations have still been pretty large. But what I take away from it most of all is that really that's what's ramped up growth in the equity markets rather than economic growth or fundamentals, which we think are overvalued. So it's kind of a scary proposition when companies are not spending the capital. Well, first of all, there's something this table doesn't show us, is how corporations are levering up their balance sheets or spending cash that would otherwise go towards growth capital expenditures, so that they can look out 10, 20 years and say, we're going to build this infrastructure so that in the future we have growth. That's what drives stock valuation. If the only thing they have left to do is buy back their stock, that doesn't tell you a lot about their growth prospects for the future, and that is problematic.
In essence, that also tells us why the FOMC's quantitative easing hasn't been as impactful as it might otherwise have been, because corporations have been using that capital to make stock purchases of their own companies. So not only has it rendered monetary policy somewhat less effective, but it also has it's also created a situation where corporations have taken a lot of the supply of equity out of the market at the same time, and that again makes individual shares look rather expensive.
So when they buy back their own stock, are they doing it at market value, or are they driving up their own stock price by buying back?
Absolutely.
I mean, so that to me is what's really scary.
Well,
they're not using that money to put back into their company, and they're driving their stock price up.
But remember how C-suite executives get compensated. They get compensated by the stock value because they get a lot of options and warrants. And
right. Well, I know, but
so that there's two problems there.
As a buyer of equities, that scares me. The whole thing. Yeah.
Right. Well, you're right. It really limits. It tells you that they don't think enough about their business for the next 5 years to go plow money back into it with capex, growth capex, that they're going to just buy back stock. And they temporarily, and don't forget, they have a lot of pressure put on them by other activist shareholders, usually hedge fund type shareholders, who want immediate returns, which is fine and dandy, but the CEO and other high-level executives are conflicted because they get compensated through stock options. So they too would like the stock to go up quickly and be able to exercise some options at higher valuations. So it's a very short-term thing. You know, it's a short-term runway.
I lost my train of thought. Sorry. I had a question. Okay, I can't think of it. Sorry.
Not a worry. Thank you for bringing that up, because I think it's a very interesting topic of conversation, and it really does explain a lot about.
I remembered it. Where does it end? That's my question. Like, is there any kind of regulation on how much they can buy back or anything?
Well, in Canada we have rules, NCIB, so that is a normal course issuer bid, and they have to apply to a company has to apply to the securities regulators and state that they would like to institute an NCIB, normal course issuer bid, for 1 year, for the following year, or the coming year rather, and they're usually 5% is a normal course issuer bid, but they can buy back up to 5% of the stock through the open market, and there are rules as to how much they can buy per day, which sometimes is not a lot. Some of them can go up and get exemptions up to 10% of their outstanding stock over the course of this coming year. So yes, they are regulated by how much they can buy, but you know, it still could be pretty impactful if you buy 5% of the stock. And then the problem becomes it skews some valuation metrics like price to earnings ratios or earnings per share, because if your earnings remain the same but your denominator and share count drops substantially because you bought back a pile of stock, then your EPS goes up, which affects your PE multiple as well. So we think they're artificially high, and it's not a very good way to look at stock market or individual stock valuation. We think EV to EBITDA, enterprise value to EBITDA, which we have a slide up there, and it's grossly overvalued in my opinion.
Yeah.
You know, and Scott says I wouldn't buy a stock up, you know, north of 8.5 times multiple. In fact, you know, we're looking to buy stocks at, you know, 5 times multiples if we can. I'm certainly not buying the market at 12.5 times.
Right. Thank you.
All right, excellent questions and great discussion. Thanks so much, Kathy. If anybody else, we're gonna end it now. But if anybody has a question and would like to email us with that question, Paul and I are more than happy, and Bianca as well, to get those questions. It gives us potential topics for our weekly webinars. And we certainly are always interested to hear what our listeners have to say. Speaking of which, if you ever have any feedback about how you would like to see these webinars, we do from time to time shift around the manner of our presentation, but we want to make sure that our clients like what they're getting, and if you do have anything you want to hear from us, please don't hesitate. Okay, that's it for another week. Thanks very much for taking the time to tune in. Have a great rest of the week. Have a good weekend, and we'll be back with another report next Tuesday. This is Scott Tomlinson, and I am signing off.